Here in this video, we will be going over all of your breaking news for markets today and what you need to know, because is this rally really sustainable? Well, it comes down to a couple different things, one of which, well, reports earnings today and after hours, and then two of which report earnings tomorrow and after hours. So really over the next 24 to 36 hours, we're going to have a lot better understanding of where markets are going next. And I want to give you a little bit of a heads up. Hey, if this happens, well, this happens. If that happens, well, this happens. And by the end of this video, you're going to feel like you have a much better understanding of where we are right now and what could be coming next and what to watch out for. So we're going to go ahead and jump into it. If you find any value out of this video, hit that like button and subscribe to the channel. Don't do that right now. Do that if you find value out of the video, and let's get into it. So first things first, important to pay attention to is the technicals on the Nasdaq. Now, I'm really looking at the Nasdaq right now because your Nasdaq earnings are the important ones, at least for even the S&P, right? Microsoft, Apple, Nvidia, Tesla yesterday, Meta, all of these different big tech names, they're going to move the Nasdaq a lot. And most people are invested towards the Nasdaq. They're at least skewed towards technology for the most part. Most of you guys, I would say. So I like to pay attention to the Nasdaq, and the Nasdaq really reacts well off of technical levels. And that's exactly where I want to start with here, because you were a lot higher at one point in the trading day today. You fell down towards the low of the day. You hit close to this 100-day moving average. It seems like you found support here and bounced. If you hold support at the 100-day moving average, that could set you up for an upside move from here. And the biggest thing that will dictate in the near term what happens with stocks are your big tech earnings. Here today and after hours, you will get Meta, IBM, Ford, Chipotle, ServiceNow, Lam Research, Vail, Align, and some other names. I'll tell you, Meta has historically a large sympathy effect to other big tech names. So what that really means is if Meta goes down 20%, it tends to take a Microsoft, a Google, a Apple, or whatnot down with it, right? Anywhere from 0.5% to 1%, and that tends to move the markets a lot because your big tech stocks affect big tech stocks that affect the S&P and the Nasdaq on a headline basis. Then you can make the argument that, well, if the S&P and the Nasdaq fall, a lot of the algorithms and computers, they go out and sell off just stocks en masse, okay? That's why Meta could be important here today in after hours. Likely around the time you guys are watching this video, Meta will be reporting. Now, Meta's a problem child for me this earnings season. In terms of, I think they're going to have good numbers. I don't think there's going to be anything that's super negative. And with the consumer slowing down, let's be honest, the data is really not showing the consumer slowing down, but the consumer is slowing down. Like, go out to your local restaurant, the one that used to be super busy. Odds are it's not as busy as it was before. People are cutting back, and you see the data on that in some areas you don't as much. But you could even make an argument that the consumer slowing down, maybe not buying as many, things, could be a positive for a company like Meta. At least initially, as companies see that slowdown, they're like, hey, we should just advertise some more. It's a tax write-off. Let's advertise, try to get as much business as possible. If they do that and find out it's not working, well, then they probably inevitably will see an advertising slowdown. But I don't think they're seeing an advertising slowdown right now. The problem is Meta gapped up last earnings over 20% and has continued to go higher and is really like $30 off of $40 off of all-time highs. You're still sitting at basically all-time highs for Meta. The expectations are way up there, way up there. So Meta has to come out and just completely shock everyone. And that's what they did last earnings, right? Meta came out, they said, hey, we're going to start issuing this dividend, we're going to have buybacks. They threw everything at the bears, and that's why Meta went up 20%. I don't know what else Meta can throw at markets that will impress markets compared to last quarter earnings. And that's why I'm a little bit on the fence here with Meta earnings. I think it's possible, if not likely, Meta goes down about 5 to 10%, even on really good numbers. Like, you're going to have to see a stupid good guidance or something along those lines for Meta to go up another 5 or 10% from here. That'll put Meta at brand new all-time highs. It's possible. I just think the odds are stacked against it at this moment in time. If you take a look at what the markets are pricing in for earnings moves, Meta's sitting at 9% up or down. That's a huge move. And what we've found recently is whatever the markets are pricing in is what stocks tend to move. Take Tesla for an example. Tesla was pricing in 10% after their earnings. What happened? Tesla moved 10% after their earnings, and now they're up 12% today. They've went up another 2%, but largely these stocks are moving in line with their earnings expectations. You also have Lam Research, that is a big memory provider for GPUs, and deemed as one of your AI stocks. And they're expecting an 8% move. That could directly affect NVIDIA, SMCI, Intel, Samsung, some of your other memory suppliers, if not just outright AI stocks. So that's another big one to watch here in after hours. IBM, I guess a lesser qualified or lesser known AI stock as well, but some people own IBM for their AI, intellectual properties, if you will. So another one to watch there. And then Google and Microsoft coming tomorrow. You're expecting 5% for Microsoft and a 6% move for Google. Again, this can be up or down, so you are going to get a lot of volatility, most likely. As far as what the options are pricing in, yeah, these stocks are going to move pretty large relative to what they normally move. Like Microsoft moving 5-6%, big move. Google tends to move a lot, but Microsoft not as much. It's pretty normal in earnings season to see Microsoft pricing in like 3 to 4%. So it's a little bit high this time. And that's why I said in the beginning of this video, the next 24, 36 hours, we're going to have a lot more clarity what happens to markets. And again, unfortunately, if you look at Microsoft, pull that up on the charts, you're sitting at basically all-time highs for Microsoft. If you look at Alphabet, you're basically trading, well, you almost are trading at all-time highs for Google. You're like $1 off of all-time highs. It's hard to justify and say, hey, these stocks should go higher. They're already richly valued. And that makes me a little bit more concerned for just the overall headline S&P and the Nasdaq. But if we can get through Google, Microsoft, and Meta earnings today and after hours, and markets are just fine and these stocks do little to nothing or go higher, markets are going higher from here. That's what you want to watch out for. If these stocks fall, let's say they all fall 5 to 10%, stocks are probably going lower because normally you have Apple to save the day, which will be next week, and it looks like Apple earnings are going to be not so great. So Apple is probably not going to bail out the markets this time like they have before, and NVIDIA is going to be like a month from now, 3 weeks or so from now. So you're not going to get any bailing out there also. But generally speaking, I am expecting decent earnings from all of these big tech. Problem is, again, just to reiterate and be very clear, expectations are high. Everyone's expecting good earnings. And when expectations are high and you're expecting good earnings, you need great earnings. You need exceptional earnings. Fantastic guidance, whatever terminology you want to put on it. Hopefully I'm making my point here. It's hard to deliver that. It is very hard to deliver that. You have to have some kind of NVIDIA earnings where you just guide up 30, 40% higher than Wall Street's expecting. And I don't know if that's even possible with Microsoft, Google, or Meta at this current moment in time. Now, this morning, you did get durable goods orders month over month that came in positive 2.6%. This gave the markets a little bit of a boost as well, because in the end, you want to see the economy as strong as possible. If it takes longer to get inflation down, fine. Markets are totally cool with that. You want to see the economy doing as well as possible for as long as possible. And that's ultimately what will drive markets higher. If we were teetering on the brink of a recession right now and the Fed was looking to cut rates at the next meeting, markets would be substantially lower than where they are today. Markets would be way, way, way lower than where we are now. You'd be back to 2022 levels where markets were pricing in, recession, right? Down here in the 250s on the Nasdaq. You could fall 45% if you were to be heading into a recession. Again, that's not happening. That has put upside pressure on bond yields. But if earnings come in good, the economic data comes in good, but maybe the Fed just reiterates coming, I believe they have their next meeting next week. I'll go ahead and pull that up. Is it May 1st? I believe it's May 1st, the next Fed meeting. Yes, May 1st. If the Fed comes out and they sound, a little bit more dovish, I think you're priced for maybe yields to come down a little bit. And what I mean there is 10-year Treasury yields are at 4.65%. They're up 5 basis points today. They've been going insane to the upside in 2024. And maybe there's some room for yields to fall, and that could be very positive for stocks, right? If the Fed is still going to hold their guidance of 2 to 3 rate cuts in 2024, markets are barely pricing in 2. Like most people are pricing in 1 rate cut, let alone if inflation does start to fall with the next CPI report, which will be around May 10th, and then the next one after that, which will be around June 10th. If you do get progress on inflation, if you do get the Fed that's still just overall pretty dovish and wants to cut rates, then I do think this could be a tailwind for stocks that could help boost stocks as long as the economy stays well. But this is really something over the next 2 to 3 months to be watching, and it could help the markets maybe in the shorter term if yields did fall on big tech earnings, but it's really all going to be about big tech earnings. Now, I am going to play this clip from CNBC. I want your opinions on this down below in the comment section.
Genuity Chief Market Strategist Tony Dwyer joins us now for more on the markets. I should say rates and earnings, both playing a factor on the equity markets. Speaking of the equity markets, you had a note out on the 22nd, I believe, which predicted the bounce that we've seen largely over the last few days. As you look back, do you think that the recent downturn was largely due to technical factors or fundamental factors? And what does that say about the upturn that we are currently experiencing?
Well, good morning. It just, you had been up so far so fast, and optimism had become extreme. Basically, everybody that wanted to buy had bought, and that showed up in all the data that we had. It was a record run of, we look at a weekly stochastic, just using some technical stuff, even though I'm a macro guy. Our weekly stochastic on the S&P was above 90 for, I think, 19 straight weeks. That just doesn't happen. It's historically pretty unique. So when you get that kind of run, you're due for a pullback, and higher rates have given us that opportunity for a pullback. Honestly, it looks a lot like it did last August. You're in a bull market. You had a heck of a run. You got overly optimistic across the board, and you're getting a pullback based on rates.
So what does that tell you about kind of what to expect in the future? Are you encouraged by what you've seen from earnings so far?
Earnings are pretty good, but again, so it's very interesting. When you look at last year and even the first quarter of this year, if you exclude the Magnificent Seven from the S&P operating profits, you have that's 100% of the earnings growth. You would have negative earnings. Also, if you go into the end of this year, that's going to change, where you're going to have a much better distribution of earnings. So the real bull story for the broadening out of the market comes down to 2 things. You have to have lower rates. That's what drove the recovery that we had off of last October's October 27th low. It was lower rates and hopes for a broader distribution of earnings, not just being concentrated on the Mag 7. So those 2 things actually come into play. So our game plan coming into this year was to have some corrective action based upon just a historic run we've had. And we're in the process of that. And I think once you work your way through that, it's going to set up for a real good ending to the year.
Hey, Tony, a lot of the doves are leaning on a lot of leading indicators, NFIB hiring intentions, or this PMI services employment index, or median price in existing homes suggesting disinflation in the back half. You still buy that?
Yeah, Carl, it's very interesting. Any survey-based thing like the NFIB Hirings Plans Index hit a cycle low in its most recent reading. All the ISM employment indices are right bouncing along the cycle low. We'll get a better reading next week. Ultimately, I can't find where the employment is happening when you look at any of the small business hiring plans or any of the manufacturing sector. So where is the employment data really booming to the point that it's keeping monetary policy high? And I think that's where, as we work through the middle of the year, we do actually get some weakening of the employment data. That gives the Fed plenty of room after a historic run higher in rates to actually cut rates. Carl, just like 7 rate cuts at the end of December was excessive, only 1 rate cut may be as well. The market has gotten it wrong over the course of the last 2 years of how many remember going into 2022, there were only going to be 3 rate hikes, meaning 75 basis points was predicted to be the high of the cycle. So I think we just have to continue to look for what can turn the tide in its earnings and distribution and its lower rates.
The Goldilocks of rates, 7 too high, 3 or 0 to 1, maybe too low, and we'll see 2 to 3 seems like consensus right now. Thank you, Tony.
With that said, if you take a look at CNN's Fear and Greed Index, you're still sitting at 41, which is fearful, which suggests to me maybe if earnings do come in okay or good and big tech, does okay, well, maybe you could go back into neutral a little bit more, right? Get into the high 50s, and maybe that means a little bit more upside from here. But then again, there's still quite a ways you could fall into a more fearful market environment. Over on StockTwits, under the ticker SPY, this is the ETF for the S&P 500, sentiment today is at 72, which is bullish. Yesterday, you were at 68, which was bullish. So people are feeling a little bit more bullish today than they were yesterday. Now, message volume is higher as well at 51 today. Yesterday was normal at 48, and the participation ratio is at 53, which is considered normal. By December 18th, there's 34.1% odds of 2 rate cuts. So 2 rate cuts in 2024 is still barely priced in. Right behind it is 33.5% odds of only 1 cut in 2024, and there's a 12.3% chance of no cuts in 2024. So inflationary data, economic data will continue to be important because it's really a toss-up between 1 cut, 2 cuts, no cuts, 3 cuts. It's still, everything is still on the table here, just depending on how the data comes out. And tomorrow, you will be getting some very important data. It is your GDP growth rate, quarter-over-quarter advanced estimates for Q1. You're expecting around 2.5 to 2.3% quarter-over-quarter GDP. The estimates are going to vary depending on what you look like. It says here consensus is 2.5%. The forecast is 2.3%. So different sources are going to have slightly different estimates. But I'll tell you right now, anything close to these numbers is going to be fantastic. It becomes problematic if you're less than like 1%, which if that were to happen tomorrow, that would be very unforecasted and likely cause a pretty steep sell-off in markets. That's not my base case. I think roughly these numbers look appropriate, and that would still be seen as a huge positive for markets and for economic activity if we do continue to see strong economic data. Now, you will get pending home sales coming out tomorrow, month over month, year over year. Kansas Fed Composite Index, Kansas Fed Manufacturing Index, a bunch of bond auctions, and the BOJ interest rate decision that will be coming out at 11 p.m. Tomorrow night. So that will also be important. You get retail inventories, good trades balance, initial jobless claims, all kinds of different data points. But the main one that markets will react to is this GDP growth rate quarter over quarter. With that said, it's clear earnings are the big catalyst. Now, if big tech earnings come in bad, then you're looking at a test of that 200-day moving average in a relatively short amount of time. Let's be honest there. That would take you down to about 395. I don't think the 100-day moving average would hold up support. And I think we're going to know a lot more when Meta reports earnings. Here at the time of recording this video, they will report earnings in about 40 minutes or so. And again, likely by the time you guys are seeing this video, earnings are roughly going to be coming out like right at around the time you guys are watching this video. If Meta's bad, if Microsoft's bad, if Google's bad, or their stocks just fall a lot because it's hard for them to impress investors at this point, then you're going to be trending down to that 200-day moving average. If indeed earnings are okay or good and those stocks go higher, I think that the relative cap on the Nasdaq and the S&P are the all-time highs that we previously set. I don't think in this market environment where you're not getting cuts from the Fed, I don't think you're going to, break out to new all-time highs. I don't think there's a lot of upside potential here. Of course, there is maybe upside potential from now until all-time highs again. That would be a little bit over, 5.3% or so. But even getting back to all-time highs, I think is going to be a little bit challenging given the steep sell-off that we just recently seen. This normally happens if you are in a downturn, right? You tend to fall, hit the first bottom, you tend to bounce, not quite up to, your prior highs, and then you tend to sell off, hit a new low, bounce again, not quite to your prior highs, sell off again, hit a new low. This may just be the bounce, and we'll have to see. It's still possible that stocks could fall a lot more from here, but to be honest, I don't know until we get earnings. When we get earnings from big tech, I will be able to definitively tell you, in my opinion, where we're going next. But this is kind of the blueprint. If these stocks don't move at all, then I would expect you trade sideways, if not trade down. And it's as simple as that. So let me know what you think about this information down below in the comment section. Provide your thoughts as well down there. In the meantime, hit the like button as well as subscribe to the channel if you found value out of this video, and especially if you made it to the end of this video, stick around a while. These videos might help you make some money. You guys have a great rest of your day, and I will see you in the next one.